Hello.
Hi, everyone. Good afternoon. My name is Maggie Shu, and I'm head of go-to-market at A16Z Crypto. Prior to this, I was at Amazon leading go-to-market for Amazon Managed Blockchain, which is their blockchain service. And then before that, I was the BD lead at an early decentralized exchange called AirSwap.
And I'm Pyrs Carvolth. I sit on the go-to-market team with Maggie. I've been here for almost 3 years. Prior to this, I ran the web3 practice at DraftKings, which is a large online gambling platform. And prior to that, had a fairly boring TradFi career in equity derivatives. I'll turn it over to Maggie, and you'll see me in a little bit.
Thanks, Pyrs. So today we'll be speaking a bit about some Web3 go-to-market frameworks and metrics, as well as how we provide go-to-market support to you. And then Pyrs will talk about all things deal making, and we'll end with a working session around deal making. So I encourage you to start thinking about an active deal that you might be working on. So I wanted to review 5 common go-to-market motions with you. And many of you have built and scaled companies before, so these will likely not be new concepts, but I thought it would be a good framing regardless. The first one is product-led. The product itself is really driving the go-to-market, so a potential customer user is going, they're signing up, they're creating an account, they're downloading an app. The second one is sales-led. You have a sales team hand-holding the customer, and in this case, it might be because the sales process is a bit more tricky, or there's some questions around integration, something like that. The third one, pretty self-explanatory. It's developer-led, and in this case, developers are the main folks that you're targeting to onboard. The next one, community-based. This could apply to NFT communities. It could apply to social apps, consumer apps. It could apply to games, but it also applies to things like layer 1 and layer 2 blockchains. And in this case, you're looking to create that two-way engagement, both online and offline with the community. And then finally, integrations. And in this case, you're looking to partner with partners that likely have large distribution, and you're likely looking to leverage their distribution. And we see a lot of this in Web3. So most companies use some combination of motions, or they might start with one and move to another. And this is a mapping of some of our portfolio companies against their relative go-to-market motions. I will deep dive into one portfolio company, Loop, which provides infrastructure for on-chain auto payments. And they actually use all 5 go-to-market motions pretty effectively. I wanted to use this example because Loop is a seed stage company, so they have similar resourcing to what you might have. So the first one here is product-led. They have a self-serve onboarding portal where customers can get started themselves. The next one, sales-led. They also have this meeting booking link that's directly on their website where interested customers can sign up to speak with the team. Developer-led, obviously, they have their SDKs here. They're posting on X. They're putting out newsletters. And then finally, they've nailed some really key integrations, in this case with Stripe. So I'm actually curious to hear from a few of you what your primary go-to-market motion is. If I could get 1 or 2 volunteers to just talk about the motion and what you might do around that, that would be wonderful. And I know there's some mic runners, so we'll wait a second for that. But yeah, I would love to hear from a few of you what your go-to-market motions are.
My old product before the pivot started out developer-led, moved to product-led, and then we settled on a combination of sales and integration and channel partners, and then we pivoted.
It's great. You've kind of gone through the gamut.
It was so fun. No.
Thank you for sharing. Anyone else?
Hi, Maggie.
Hi.
Amir with Skyfire. We're doing something very similar with the exception of the product-led blocks that you have there, but I think we're doing everything else.
That's great to hear. Thank you both for sharing. I think it's really important, and both of you have highlighted that you might start with one and move to another. So I wanted to focus the rest of this section on the last 3 go-to-market motions, and I wanted to do that because these are ones you can start on now, regardless if you have a product or even if you're pre-product. So starting with integrations, again, Web3 go-to-market is disproportionately about integrations, but hopefully it's more than just this cursory logo lockup that we see a lot in the space. These are some real statements that we've heard from companies looking to go to market. We're looking to integrate with the top wallets, the top DEXs, large institutions. We're selling into DAO treasuries. We want to partner with the best brands and artists. These are all quite broad and really need to be broken down into measurable outcomes. So as an early stage founder, it's all about your prioritization of timing. And every time you're in a business development call, that's an opportunity cost loss. You can't be focused on product or hiring. And it feels like maybe you're the one that's getting dragged into all these conversations and you want to be doing other things. So I'd say that you really think about getting to what I call a minimum viable customer category, or MVCC. And in this case, you need to be on the initial set of calls, but you're really looking to figure out things like who is the ideal customer profile, or the ICP, who are the other stakeholders who are involved in the decision making, what is the typical sales cycle cadence? So what are kind of some of the typical things that happen along the sales cycle, as well as the typical length? And questions or concerns. So maybe there are questions that you get over and over and over again that you could address in some sort of documentation or pre-address. So once this is clear, you can then segment your targets. You can set up an inbound pipeline. It's really exciting. You just put something out there and people will send pipeline to you. You can go through that. And then most importantly, you can take this work and send it to someone else. Maybe it's a junior BD or salesperson. If you are a pre-product, you don't have to wait to go to market until you've launched. There are a number of things you can do now to really set yourself in the pole position for when you do launch. So one that's really valuable is having these targeted informational conversations with potential design partners to get feedback. You can also look at price discovery. What we just did in the last slide was mapping and prioritizing your partnership targets. And then a critical one is competitive positioning. You're going to be asked this all the time as soon as you launch, so you might as well get started on it now. I wanted to show an example of how you'd break down one of those statements. So let's say you have a new yield-bearing stablecoin and you're looking to sell into DAO treasuries. This is a statement: we're selling into all DAO treasuries. Well, how can we break this down a little bit more? I would say, well, we're looking to sell into DAO treasuries that are looking for some potential diversification. Well, hopefully that's all DAO treasuries as well. So from there, when you start talking to the treasuries, you might come across, do they have do they have goals? Do they have a treasury management committee? Do they have a treasury management plan? Even if they have that plan, do they even have the right governance to be able to go through this and diversify? Have they done this before? Do they hold other stable coins, or are they only holding their native token? And finally, are they working with any external providers? Because in this case, maybe you have to go through those providers to run that process. And so instead of just saying, we're going to target the top 5 DAO treasuries by AUM or the top 10 or whatever that list is, you go through this, and it's really you're looking at number 4, 7, 8, et cetera. Another example is what integrations to think about as a new L1 or L2. And this is a playbook that's pretty well documented at this point. So there's now, I'd say, a standard set of applications and infra that pretty much every new blockchain needs here. And for each one, you can either get a partner to deploy on your chain, or you can build it yourself. Moving on to B2C, business to customer, business to community. Again, these are actual statements that we've heard from companies. We're making this so simple that your grandmother could use it. We're onboarding the next billion people to Web3. I mean, how many times have you heard those first 2 statements? And in this category, the key measurable outcomes are about finding and engaging potential customers. So in this case, you have access to all the Web 2 growth levers and all the Web 3 growth levers. And on the Web 2 side, this includes things like both organic and paid channels. And on the Web 3 side, it would be things like tokens, or if you're using points, on the points. Arguably, you need to be thinking about all of these, because what you're looking to do is to combine both off-chain attribution with on-chain attribution. And you're never going to get this perfectly right, but I'll provide a few ways you can think about tracking your growth. So this is a Web3 marketing process. You are taking your data, you are then analyzing it, you're performing some marketing action against it, and hopefully you're testing this through different subgroups. You're then analyzing the results, and you're adjusting. And at each part of this stack, there are a number of tools and services that you can use to help you with this. For example, this is a market map from Safari. It's a really great resource, and it shows the tools and services you can use along each part of that growth stack. This is an eye chart, I know, but I wanted to provide some common Web 2 growth metrics and adapt them to Web 3. So starting with the Web 2 metrics, we've all heard of CAC and LTV. So customer acquisition cost is basically everything that goes into acquiring one customer. LTV is the lifetime value of a customer. So if you have a SaaS business and a customer is generally with you for about 2 years, you take their monthly fee and multiply that by 2. Then you have conversion, retention, and churn. So conversion, out of all the people you've targeted, how many people actually made a purchase? Retention, how many people are retained after a set number of days? And then vice versa, churn, how many customers have churned out? For Web 3, you actually might use the exact same calculations as the Web 2 side. So some of your businesses will have very Web 2-like dynamics, and you can use pretty much these same calculations that are standard. Others of you might need to adapt them. And I've spoken with a number of marketing and growth leaders across our portfolio. There are no standards. So everyone's kind of figuring this out and adapting it for themselves. So a few examples here, and again, these are just potential examples. They're not kind of exhaustive. But one on the CAC side would be adding token incentives. So if you're launching quests, you obviously have to take that into account in your acquisition costs. The next one is, in terms of LTV, maybe this is their contribution to transaction fees, but it could also be something like their contribution to TVL. And then on the conversion, retention, and churn, similar idea. Conversion might be out of everyone you've targeted, how many % own your NFT. Retention you can do with the wallet analysis, so what % have done an on-chain action after X number of days. Again, vice versa, what % of wallets are inactive. And then I would add two here, engagement and share of wallet. Again, these are two that are tracked in a Web2 way, but I think they're hypercritical when you're thinking about Web3 marketing and growth. So engagement, this is both online and offline. Online could be NFTs acquired, it could be their engagement in your Discord server, whether they're liking your posts on X, and offline could be events attended. You might be tracking which events around the world they've been to, maybe they have POAPs and it's easier to do that. And then finally, share of wallet analysis. You can do a literal share of wallet analysis. That's one of the benefits of Web3. A few examples. So Daylight is a company in our portfolio. They're building a decentralized energy network. They have both traditional partnerships, and they also did this great on-chain summer partnership with over 100,000 mints. One example from your cohort is BlockSense. So the left side shows their Discord, also shows a blog post, and then the right side is from a Quest campaign that they ran. A word of warning about your platform selection, because I'd say at least half of our portfolio companies, and probably more, I think the number's a little bit low, have had an issue with what we call a legacy Web2 platform over the past year. And they've escalated this to us. And I know some of this is unavoidable. You can't kind of get off all the Web2 platforms, but you really want to think about diversifying away when you can. For example, with regards to communications and engagement, most people are still using the top 4 because that's where the largest distribution is. But I would really encourage you to start thinking about decentralized solutions. For example, what is your Farcaster strategy? What is your XMTP strategy? And I think those can be really effective versus, we have companies that have gotten blocked because there's some sort of odd Twilio filtering and their messages aren't getting sent out to their fans. Finally, on the B2D side, I hear this all the time. We are targeting all developers. And again, let's break this down. So if you have an L1, it might be more specific. It might be something like this. We are targeting net new native builders, building net new applications to grow network value. And then from there, you have these measurable outcomes, contract deployers, number of calls. And these are things that we track on our State of Crypto report. Base recently launched this pretty cool analysis. It's an on-chain score to rate each base name on a variety of categories, including swaps, bridging, and contract interactions. And Compass Labs, which was a prior CSX company, they have fairly robust developer documentation. But one thing that ended up being really successful from a go-to-market perspective was this example GitHub repo that they launched. And Compass offers a DeFi simulation engine, and it was a really cool way for potential users to try these specific strategies. This has been one of their most effective ways of onboarding potential new customers. And I think it's a really great example of showing, not telling. And finally, in-person gatherings, can't discount that in Web3. These are critical to building a developer community, and they can be of all sizes, from meetups to hackathons to full-blown summits. These are a few recent examples. So you have Farcaster's Dev Day, Coinbase's Basecamp, Solana Breakpoint. I don't know if any of you were at any of these. I was at a few. And what was cool was each of these was really authentic to their developer community. But what I think is most important is that they were all executed with a variety of budgets and production support. So everything from a single room all the way through to renting out a full-blown convention center. Final thoughts on go-to-market, defining success. I think it's really important to be clear and opinionated on your KPIs. In terms of monitoring your progress, I would set these as 3-month sprints. Anything less, and it's hard to see the effect of what you're doing, but also recognize that some of these deals might take over a year to close, so I wouldn't necessarily tie yourself to progress that has to be made in a set amount of time. And then finally, this is not something that you're going to set once and forget about it. This is this really active process where you're constantly testing and adjusting your marketing mix. Okay, so moving on to go-to-market support. How can we help you? We can help in a variety of ways, everything from talking through your product launch, helping with partnerships, introductions, deal negotiation, pricing strategy, issues with vendors. And I know some of you have office hours set up this week. Really excited to chat about that. What's really cool, though, is we're not alone. You have support across many, many other teams as well. And we can really help orchestrate across all of these. So please use us as a first point of contact. So the other week you heard from Scott and the research team on things like business models. You had the amazing talk from Eddie on token models, and the engineering team can help with things like that. And finally, marketing. That'll come up next week, and you'll hear from the marketing team on all things comms and marketing. So again, feel free to use us as kind of that first point of contact, but you have a lot of go-to-market resources across A16Z crypto. And with that, I'll pass it to Pyrs to talk about deal making.
Thank you for having us. As Maggie mentioned, integrations and partnerships take up an inordinate amount of mind share for founders in Web3. And so what we wanted to do was spend a little time focusing on this specifically. It's a relatively flexible, malleable space. No deal is the same, so no negotiation is the same. So what we're going to try to do is distill a lot of learnings from our collective mind share down into something that is digestible and hopefully applicable for a broad range of founders. I know we have some founders who have already built and scaled companies, some founders who are doing it for the first time. Definitely meant to be interactive. I'm the youngest of 4 kids, so like I fight for every word I get, which means you should also fight back. If you have a question or something, we have mic runners, just let us know. But we'll also have Q&A at the end. So I don't stand up here as like the be-all, end-all resource for negotiating a deal. There are numerous points of literature that are out there to digest. In fact, A16Z crypto itself is home to scholars and authorities on this discipline. I could have put up the academic works by Tim Roughgarden and Scott Commoners up here. I could have put up some of the deal terms that our investment team have negotiated. I could have put up hiring contracts that our talent team has helped with. But I wanted to double click on the practice versus the theory with respect to go-to-market. Does anyone know what Occam's razor is generally? Shout it out. Go ahead. The simplest explanation is usually the likeliest or the best one. So my distilled version of this for Web3 looks like this. It's very, very challenging to negotiate a deal in Web3. If anyone hasn't seen Training Day, I highly recommend it. This is from Training Day. Don't take any pictures of this, please. The reason it's hard in the Web3 space is there's a lack of standardization today, and there's evolving business models. It's also challenging because the tokenomics and valuation might obscure price discovery, might prevent you from actually figuring out how to value a certain deal or its impact on your business. Decentralization and governance also comes into play here. How do you move through an open governance process to get a vote forward that has a deal attached to it? Trust and anonymity. How do you develop trust metrics or trust mechanics for a PFP and a pseudonym? Like you have to actually talk to the other person on the other side of the table. And regulatory uncertainty, of course. The inconsistent regulatory landscape is always kind of looming. We can kind of distill this down into a more academic representation, and this is just borrowing like a basic concept from social behavior, which is basically saying that you have to consider both the individual and the environment to understand their behavior. And in this space, you can kind of think of that as like, 1, you're going to be negotiating against the founder, and 2, they are constrained by the Web3 technology that we're all operating within. So what does that really mean? When you're negotiating with another founder in Web3, you get all of the legacy baggage of founders, right? Ego, aversion, all these things. And the one thing that I would just highlight here in particular for those of you who are, potentially approaching a negotiation with a partner or thinking about one, the zero-sum fallacy is particularly troubling for founders in Web3 because we have this like grow the pie ethos, right? Like we talk a lot about, it's early, the technology is going to get there. We want to make the market bigger, not our market share bigger. And what that winds up doing for a lot of founders is it kind of paralyzes them because they feel at odds with this idea of, wait, we should be growing the pie, but I also have to carve out my slice. So it kind of neutralizes their ability to negotiate a deal that focuses on their market share expansion rather than the overall market expansion. So how do we think about coaching through this dynamic? We actually don't coach for like best, we coach for better. It really boils down to one thing. If you can better manage the people and problem solving of a specific negotiation, you're going to be able to influence a deal or a partnership. And founders are naturally really good at problem solving, right? You wouldn't be founders if you weren't good at the problem solving part of this. So we wind up spending a lot of time on the people aspect, or in layman's terms, how do you get people to like you? because with like comes trust, and with trust comes the ability to win and influence deals. And so we'll go into some of these. It's more of like again, this is a very amorphous kind of talk about like, wait, how do you get somebody to like you? Well, there's two people in that relationship, so it's really going to depend on the other person on the other side. But what we don't do is we don't try to enforce like some rigid system that is similar to the. If anyone's an Always Sunny fan, you know that this outcome can end suboptimally. So we're not going to try to teach you some like rigid framework that you have to adhere to. But what we will do is talk very briefly about this general purpose framework. Again, all these inputs are like really distilled. Some of the books I put up on that first slide, a lot of what I've learned over the years is distilled down into this basic framework. And so you have the timeline of like, okay, you're thinking about a given category of partnerships. You've done all the work of identifying like who the potential targets are. Now, how do you move from the preparation phase to the closing and post-activation phase? And we're just going to talk quickly about these things. The one piece I won't spend a ton of time on again is relationship building. The reason for that is everyone has their own style, right? And everyone's different. So the two things I would say on relationship building and the two highest indicators of success are the ability to listen actively. Like if you're not actively listening to the person across from you, then you're not hearing what they're saying and you're totally neutralized from being able to address any problems. And then two, to be interesting, you have to be interested. And so I think we all spend a lot of time in our lives like feigning interest in what other people are saying. And so you have to do that to start developing a rapport with somebody. So those are the two things I would just keep in mind whenever you find yourself locked in like a room where you're like, God, I really don't want to be here right now. You have to listen actively and you have to be interested to be interesting. So moving on from the relationship building aspect, diligence. Let's say that you need to integrate, you need a native stablecoin integration. Well, how do you get into a room with a stablecoin issuer and successfully negotiate? If you don't have any information, then where are you going from? And so Maggie and I actually get pulled into these conversations like mid-stage usually, and we learn that founders have either incomplete or insufficient information about the parties they're negotiating against. So the one thing I would immediately encourage you to do, if you're not already doing it, use every single node in your network to find information and catalog it in your brain and start building market intelligence, regardless of what you think your needs are today. Having information is having power, so start doing that immediately as a first practice. But with respect to the stablecoin example specifically, there's really like 4 ways to break this down, and this applies across partnerships, but knowing who the decision makers are, very often it's actually like better to treat it like a vice. Everyone thinks like you just go to the top, like you just go to the founder CEO and you get shit done. Well, more often than not, you actually have to start lower and get like actual buy-in from the stakeholders who are going to be executing the decision that's made. And so if you treat it like a vice and you kind of go from the top and the bottom, you can squeeze on who actually is going to make the decision. So once you've gone through the diligence phase, you're now in negotiations, you're talking with a partner, you're trying to like, again, set the stage for how this negotiation is going to go. Anchoring is really just like psychological buoys of where you're going to set the market. So this Dilbert cartoon is not, I don't love Dilbert. I don't know if anyone does, sorry, but it communicates the point very accurately. Whether you're a DeFi protocol, a restaking platform, a shared sequencing marketplace, you want to use a combination of costs, both explicit, like what does it cost my business, and implicit, like what is the opportunity cost of going down this path, plus market comps. So again, this market intelligence theme is going to come back over and over again. And this is where some of the aspects of Web3 technology can be really helpful. There's a lot of information out there on governance forums. So the OP Base deal, the economics of that deal are literally plastered everywhere. Base has the opportunity to earn up to 2.75% of the OP network. And then OP is paying Base the greater of 2.5% of total net profit or 7.5% of sequencing fees. You might have to like fact check me. Oh, sorry. Greater of 2.5% of sequencer revenue or 15% of net profit. Anyway, it's out there, it's public information. Use that to your advantage. Like if you're walking into a negotiation, you don't know where to set the anchors, you can use what the publicly available information to try to get a better idea of where you should be anchoring that conversation. The one thing I would point out is there's a risk of being anchored to unrealistic expectations. So it's usually good to have a co-founder or somebody that you can, bat the ball around with to see what makes sense in terms of opening up this conversation with a partner. Framing and anchoring can be used together to influence the economics of an actual negotiation, but framing just by itself, we'll talk about for a second. This is all about how you present information to influence the perception of the mutual goal. And so this is monthly active wallet addresses of popular ZK L2s. And you'll notice, obviously, there are market leaders and market followers. And your framing of a conversation should change based on whether you're talking to a market leader or a market follower, right? If you're talking to a leader, maybe the framing is talking about how you can complement their strength. Maybe you also talk about how you can scale to accommodate the fact that they are a market leader. And you should maybe talk about that it's a low risk integration with high reward, right? Because they don't want to jeopardize their market leadership by entering into this partnership with you. It's a very valuable position where they are. Conversely, if you're talking to a market follower, maybe the framing should be along the lines of like, look, this could be like a really strategic turnaround. This could be an inflection point. We can be flexible and bespoke to your needs. It's risk-taking because you want to gain market share. The framing of that conversation is going to influence the way that it goes, and it's important to understand who's on the other side of the table and who you're talking to, and to adapt accordingly. The next piece is, kind of as you move through this negotiating process and you're building a relationship the entire time and you've anchored yourself and you frame the conversation, now how do you actually get closer to closing a deal? Well, reciprocity, or the concept of giving something of value to get something of value to make things mutually beneficial, is really important. So this is a chart of monthly trades by NFT marketplace. And let's say you're an NFT project, you're an individual creator, you're a game that needs to get assets out into the ecosystem. They know what they can do for you. They can offer you distribution and a monetization path. But do you know what you can do for them? And that's a really important piece of this. Like, what's the value you're actually driving? We hear from a lot of projects of like, well, of course we should be on OpenSea, or of course we should be featured on, XYZ NFT marketplace. Well, don't convince me, convince them. So like, what is the value you're bringing to the table? So in this case, do you have unique and exclusive content that you can offer? Are your non-fungible tokens technologically innovative? Like, do they bring a new feature that takes that marketplace away from feature parity with all the other marketplaces? Or do they do you open them up to a brand new audience that they don't have today? So that's some of this idea of like giving something of value to get something of value, or reciprocity. And then this was just announced last week, and this is a really good representation of collaboration. So Aptos is going to be acquiring HashPalette and the Palette Network. Palette Network is a Japanese blockchain. Aptos is collaborating with them so that they can enter into the Japanese market. It's a very one, regulatory more friendly market, and two, very adoptive friendly market. And they also have the relationship with the World Expo, which is a in-person event from April to October of 2025 that's expected to draw 28 million people to Osaka. And HashPalette has the exclusive rights to the digital wallet that will be present at that event. So this is, again, a really, really collaborative, interesting deal for Aptos to be doing. It's one of the first of its kind. I think it's going to be kind of a trend. You're going to see some of this maybe faltering infra start looking to new and innovative infra to kind of carry them along and usher them into a new age of innovation. And so all of these things, I just talked for a really long time. All of these things go into a single deal negotiation, and ideally over the course of your startup life, you're going to have multiple of these. So this is hopefully just a general framework for you to continue to think about as you move through the life cycle of your company, and helps you feel like instead of playing checkers, you are playing chess. That's it. We're going to do Q&A.
So we help basically dApps accept any token as payment.
Sorry, say it again.
We help dApps accept any token as a form of payment.
Yeah.
And so we work with bridges and aggregators, right? That's been a great BD effort for us. So partnering with a particular bridge, and then when people come to them and say I want to integrate this in my dApp, they can forward them our way. Eventually, we want to replace bridges entirely, right? So in our long term, right now we're sending flow to bridges, but eventually we would probably stop doing that. And so there's a degree to which that is eventually going to be quite competitive. So I guess in a similar way, how do you sort of handle that? How do you make sure you don't lie, but also not enter into agreements that are not going to be good for
I have
us?
some thoughts, and then Maggie, you can also give it your answer. So very tactically, the way that I would think about this, just like really quickly off the cuff, is I would establish these as affiliate relationships contractually, where your flow is rewarded, where you're actually getting rewarded for the flow that you're sending to the bridges, and it establishes a relationship of like friendliness. Like, okay, and affiliate deals are very well documented, very well structured legacy Web2 models. And then what I wouldn't do is lock yourselves into some sort of period of exclusivity or some sort of clause in that agreement that limits your ability to expand outside of the scope of that agreement. And so over time, just slowly moving away and sending less flow just kind of looks like you're not as productive as of an affiliate as you once were, and it reduces the friction to overall exiting of a relationship. That's tactically how I would do it.
So it kind of sounds like you're like flipping it, where like we're actually benefiting quite a lot from them sending customers to us, but now we're almost like charging them for that.
Correct.
Interesting. Okay, cool.
Yeah.
How does that work when the payments are made in like a token for a protocol that they would be giving out to users? And then like how would affiliates work in that case? Do you just collect some of it? Can you
I feel
ask
like
for that?
this maybe is a thing we should offline about, because like your question is very, very specific, but you also don't want to give details in public. So it's like, maybe we'll just talk about it later.
But I'd say one point is like in Web3, oftentimes collaborators do become competitors and vice versa. And so in a landscape of constantly shifting market maps, I would just make sure you're structuring your contracts in a way that doesn't lock you into anything unnecessarily. There will be a time when they probably are like, wait, what's going on? Like those people are building, like they're my partner, but they're also building something that's potentially competitive. We've seen this time and time again. And in that case, it's better for you to have structured everything just in a way that is cleaner and where you haven't given anything up.
When you think about go-to-market and, what kind of actions you want to take, marketing, branding, PR, et cetera, or even going to conferences, is there a framework you use in trying to determine whether the cost justifies or the benefit justifies the cost? How do you think about that when the benefit is so, abstract? There's no way to really, quantify it ex ante. How do you make a smart decision in choosing how to spend your budget?
Yeah, there's no shortage of different marketing activities you could do. I would think it's about experimentation. So maybe there's a way you could test an activation at a conference versus doing a full sponsorship and then measuring the result. What were you hoping to get out of that? Is it, a list of developers? Is it certain apps? Or what is your goal going into those? In kind of the Web2 world, you will see some standard percentages for how much a company should spend on different types of marketing, for example. Again, in the Web3 space, there really aren't any standards. And so you'll see some companies that are just like all in on one type of thing and other companies that might do something else. So you have to just be constantly adjusting that. If you are, for example, a founder and you have this really great personal brand presence, maybe that's one of the most effective ways to go to market. And another project might not have that because their founder just isn't as widely known on X or something.
Hi, Dean, it's Sakai. I feel like everybody has a different answer to this question, so I'm interested in hearing what you guys could contribute. But kind of focused around the community's motion, when building out communities, how do you approach establishing like a two-sided or even multi-sided markets, especially when both sides are reluctant to jump on without the other? And as kind of a follow-up to that, are there strategies for doing that without like getting whiplash from like kind of turning your heads at the different sides of the market?
So maybe contextualize it just a little bit more.
Yeah.
The two-sided marketplace.
So we're building like a content consumption thing, right? So there's like consumers, there's creators, right?
Yep.
There's different people, like, since we're doing AI and Web3, right? There's people that might be more incentivized on the Web3 side of things, right? There's might be like Web2 content creators, Web2 consumers, right? Content consumer is so hard in the sense that, like getting people to jump onto a platform that is new, right? With the content, like will creators create if there's nobody to watch the content, right? I think these are like all sort of like established questions, but when you're kind of in a new field with a new content form in AI and Web3, right? It's like hard to look at some of the like solutions that have come before and like see a path forward.
Yeah, it's a really interesting question, because it's becoming more and more of a like repeatable question that we get. And I think what's fascinating about this space is like we've maxed out the native Web3 content. And so a lot of the conversation is like, well, how do we like, what's the next adjacent audience to that or next adjacent cohort? And it's like this idea of the digital creative. And they're typically Web2 creatives who either don't know anything about blockchain technology or have no interest in learning about it. And so you wind up with this paradigm where you're, as a platform or protocol, you're trying desperately to attract these Web2 creatives who expect you to have the audience for their distribution, and you're expecting them to bring the audience of their following to your platform. And so it's this weird dichotomy of like nobody has anything in a sense. So I would focus on carving out your market share today in the market that exists and building a network effect today rather than trying to onboard a user and then get them to produce and create. It's just, I think when you're thinking about bootstrapping a network effect, it's just easier to do it today with native creators.
What do you mean by like native creators in this context?
Nobody that has to be educated as to why like putting their art or their creative on chain is important. Like you'll be either, like in my mind, you're either going to be talking to digital creatives who can't make a living in a Web2 world, or you're going to be talking to native Web3 creatives who actually understand the value of putting their work on chain. And so I would focus less on the digital creatives who are struggling to monetize their creative in a Web2 world because they maybe don't have a following even that's going to be valuable to your platform, and focus on the creatives who actually have a following today and get the value of being on chain.
How do you parse when to actually push the gas on the go-to-market strategy, especially in the context of sort of it being a bit confusing when your product truly has product market fit in the context of all the Sibyls and all the people who are sort of opportunistically using your product just for like future rewards? I'm not sure like how you think about that, and like especially when you're like early in terms of your launch, like when to actually hit the gas on that versus like, you know, taking time and, you know, like what type of indicators you would use to justify that?
What would you be taking your time for?
I think the main question is sort of like if the product that you're launching truly is delivering sustainable value, or if people are just, you know, they see you have reputable investors and that you probably will have a token at some point, that they're just using the protocol to farm a future token launch, which like, you know, there's like millions of wallets doing that. So it's like, how do you parse if, you know, that's what's going on and you should push the gas because you actually have product market fit, or that, you know, you should not do that?
I would reframe it as the question is you have growth, but you don't know what % of the growth is like actual meaningful product fit versus speculation. And in Web3, they will always be intertwined to some degree, but I think you can take some of those other things like engagement and ways of seeing whether they're engaged with your community, whether it's going to events, engaging on conversations online and offline. You could probably set some of monitoring up to track that and get some good degree of like, these are actual people who are interested in the product and are going to be long-term users.
Hi, thanks. I have two questions. One is for go-to-market. I think when we talk to engage with customer, usually we are both try to sell product, but also try to like understand their pain point, almost like validate ideas, get new ideas. My question is like, how do you like mentally differentiating the two, and especially early stage when you engage with customer, you might not have a product, but you really want to get them interested, tell you, you know. So like, I feel like these two almost like go in the same time, or you like separate them. My second question is about deal making. It's like, I think as the company grow, you probably will like be able to negotiate bigger partners. In other words, I mean like some bigger partners, they are like have leverage over us, but some smaller partner, we have leverage over them. How would you like strategize those for different stage of a company? Like you know, what would be like a healthy mix in general?
Sure.
Yeah, I can take the first one. So in the beginning, you're looking for people who I call design partners who are willing to just share their pains with you, regardless of whether you have a product or not. And as you develop the product, you can then test and iterate and say, hey, we're working on this feature. Is that going to help? So I think the balance of the conversation shifts over time, but the whole point of you engaging with them is you're looking to build something to help them. So I think it's a very natural and authentic conversation, as long as, to Pyrs' point, you're actively listening, you're trying to understand what they're doing. The one caveat is sometimes your early design partners are asking for stuff that actually doesn't make sense for you to build for everyone else. So I would just be very careful about over-indexing on their feedback, because we've seen time and time again, especially with CSX teams, they're kind of going down rabbit holes with those partners, and then they end up with features that aren't that useful.